in the context of what's happening to the world. From there on, move to what are the implications for India and how the India-Bharat story plays out, particularly in this interesting time. First, if you go to Davos and if you look at the world today, top of mind by far is Europe. And I'll start first talking about the new ECB president, Mario Draghi. Draghi is no Trichet. And the difference between the two governors is extremely important from the point of view of how we see Europe play out. I was talking to some people who had actually worked with Draghi in his earlier avatar. And the feedback about Draghi is that he is a marketsman and has significant influence of US policy in his style of management. Now this is extremely important because for some of us who know about Trichet, Trichet was a purist and he played by copybook and essentially believed that ECB role was much narrower than what Draghi's worldview may be. And if you look at what Draghi has done in his early days after he's come in, is he's opened the floodgates of money for European banks. And therefore, I do believe that the European Central Bank approach to monetary policy will in some ways be similar to the Fed policy. And bottom line is it means a very loose monetary policy in Eurozone. And this is extremely important because you've already seen some 400 odd billion euros released and more being released in February. So he will make sure that the European situation from a money point of view is extremely comfortable. And bankers being bankers, there comes a time when greed gets ahead of risk. And if you can see some of that actually in the bond yields of Italy and Spain. If you as a banker have got 3-year money fixed rate 1% and do not want to take too much of credit risk, that is private party credit risk, and obviously you worry about Greece or Portugal on the one hand, but believe that Italy and Spain are solvent. You put all that money into bonds of these two countries. And the Italian yield, which some of us are aware, which was well over 7%, the last I checked last night, is down to 5.9% for the 10-year bond. The same thing with the Spanish bond, which was at 6%, it's now down to below 5, it's 4.9 as I saw last night. So essentially what has happened is Draghi opening the floodgates of money for banks. Banks have borrowed 3-year fixed rate at 1% and decided to have a 4 to 5% carry trade by buying Italian and Spanish bonds. And this is a very interesting way, of course, provided that Italy and Spain do not go the Greece way. This is a phenomenal way of recapitalizing European banks. This is, of course, on the fundamental assumption that Greece will hopefully find some solution, and which is the big question mark, whether the solution is disruptive or non-disruptive. And on that, I think I've heard different stories. One story is, of course, more pain for the private sector creditors, and some solution will be found, which is expected this week. And then there was an extreme view which I picked up there, that finally Eurozone may take a decision to move Greece out of Europe. The problem which they face is there a non-disruptive way of doing this? And the worry about what happens with Greece is not just Greece as we know, because Greece itself is a small country in the Eurozone, but the contagion effect which we are aware of immediately being Portugal, and thereafter whether it spreads to Spain and Italy. But the broader view is Spain and Italy will be okay, which is why European banks are busy reducing the yields of those two countries, keeping away from Portugal and Greece, and in many ways there is some more animal spirit coming back out of loose money. Moving to the other side of the equation in Europe, it is about fisc. And I had the occasion to listen to the German finance minister, Wolfgang Schäuble. And friends, he's a fiscal hawk. I've never heard somebody so surgically committed to fiscal discipline as him. And it is, for some of us who were of the view that Germany will finally relent under pressure and become loser on fisc. But after hearing him, I have serious doubts whether that is really feasible. At one point of time in this debate, there was the German finance minister, the French minister, European Competition Commission, and Martin Wolf was asking questions on this. And there was a discussion whether in the short run we need to create firewalls and protect the short run. The finance minister of Germany, Wolfgang, spoke up and said that whatever we do in the short run has to be consistent with what we do in the long run. And therefore you cannot have a policy of doing something in the short run which is inconsistent with fiscal discipline and austerity. Therefore, if I have to sum up Europe, my sense is a loose monetary policy, but a tighter fiscal policy across Europe in the next year and beyond. And this is because I think primarily driven by Germany, who is not ready for a looser fiscal policy. And in terms of Eurozone growth, my personal sense is around 0, give or take, at least in the next 12 to 24 months. Then we move from Europe to the US, and listening to Tim Geithner and our own Fareed Zakaria, it is pretty clear to me that US is a much better story. The bulls for US are saying 3% GDP, and the more pessimistic ones are saying 2%. Therefore, if I have to conclude, my sense from the US is 2 to 3% US GDP growth in 2012. But keep in mind, it's on a 14 trillion economy. So it's a big absolute number. And in this election year in the US, I think US follows a policy which is loose on monetary and even loose on fisc. So unlike a Europe which is going to be loose monetary and tight fisc, US is going to be loose monetary and loose fiscal policy, at least in 2012, which is the presidential election year. And the US can get away with it because it is the reserve currency. And what the rest of the world has to keep in mind is that what US can get away with, probably nobody else in the world can do it. And this is important because of the status of United States and the fact that it is the only currency where people finally park their money, if they at all park it in currencies. So globally, if you look at these two big countries, if you can call it that way, Eurozone, loose monetary, tight fisc, US loose monetary, loose fisc, US 2 to 3% growth, Eurozone around 0. And China is expected to be slowing down in terms of around a 7% GDP growth. So if you look at this backdrop, the next question is commodities. And I again happen to meet one of the leading commodity gurus in the world, Dan Yergin, who is the head of a energy consulting firm called Cambridge Energy Associates. And his sense was that, I just asked him the question, what do you think about oil 2012? And his view for average oil 2012 Brent was $115 average. And this is certainly more than what my expectation was. I was maybe a little bit of hope rather than necessarily belief. I was hoping that oil would be around $100 for 2012. But I have followed Dan over the years. I've known him for 15 years, and he is truly one of the leaders in global energy thought leadership. And if he says 115, he knows what he's saying. Therefore, against my hope of $100, looks like oil may actually be higher.